Alright guys, so in this session I'll be discussing this topic, US recession fears, global implications and India's outlook. So there are discussions which is going on that a recession is coming in US and how it is going to affect the entire world and India. So raising concern about the potential US recession are sparking discussions worldwide, and that's what we are going to do here. As the largest global economy, any downturn in US would have far-reaching effects on the not only its own economy, entire world, and we are also very much concerned about that. So this presentation will be talking about that. Let's get into the details now. So divided opinions on recession. There are skeptics and recession believers, those who are believing that recession will be there. So some economists argue a full-blown recession is unlikely. That won't happen. Like what happened in 2008, it won't be there. They point to positive economic indicators as evidence of stability. There are a lot of positive, after the COVID, right? How it have recovered. Though there is a base effect, but still how economy have recovered and sustained. So there is no such chance that there can be a full-blown recession. There can be a slowdown, but it will pick up again. Recession believers, others see troubling signs in the cooling job market and rising unemployment rates. So job market facing issue, unemployment rates are increasing. I'll be discussing the figures also. Okay, advancement of technology is actually the reason for cooling of job market, and that itself is the reason for unemployment rate also. And also, see, there is no, guys, when you see unemployment rate is increasing, you also need to see whether the GDP is decreasing. That's when it's a concern. GDP is increasing, at the same time unemployment is also increasing, then it is not the problem with unemployment, it is because of the technology development. The other side is also getting developed. Okay, so that won't be considered as recession. I hope this point is very clear. On the other hand, one more point I'll tell you, GDP is increasing. I told you unemployment is increasing. That's not a big concern. GDP is decreasing, unemployment is also increasing. That's a big concern. Secondly, demand is increasing. Remember, demand is increasing. Unemployment is also increasing, not a big concern, that's not a recession. Demand is decreasing, unemployment is increasing, that's when again the big problem. So in the market, demand is decreasing, that is because of lack of money supply. That's again a big concern. So demand should be there. So what countries like US will do is try to increase the demand by reducing the interest rate normally. Okay, so countries like India don't want to do that because huge population, there is no issue with demand in countries like India. So this demand equation you need to closely understand and interpret in the US context. If demand is decreasing, what you need to do? Do something for increasing demand. What you can do for that? Increase money supply. How you can do that? Rate cut, interest rate cut. So increase the money supply, demand will increase. Automatically, unemployment will come down when demand is increasing. But still, there are chances that unemployment is again going up. That is because of use of technology. That's the answer. Otherwise, when demand is going up, you should have more job opportunities. But demand is going up, job opportunities is coming. That is also a sign that the country is developing. In fact, the demand is going up, GDP is also going up, but unemployment is also going up, which means this demand have been met with the technology. That's how you need to interpret. Anyway, we'll come to that. Okay. So US GDP growth, a decade in review. If you look at 2020, COVID-19 impact, sharp economic contraction due to global pandemic, but then unprecedented challenges faced by business and individuals. So you see huge dip, right? And then what happened? Rapid rebound. So a quick recovery driven by base effect, government stimulus and vaccination efforts boost economy recovery. See guys, now remember this, when an economy, listen to this very carefully, let's talk about Nifty or for that matter any index, it's at 10,000. Now from 10,000, if you need to say there is 100% growth, how much it should move? 10,000 to 20,000. That's when 100% growth. I'm explaining base effect actually. So you are at where you are at 10,000, and if you need to have 100% growth, you need to go to 20,000. Normally it won't happen. It takes years to do that. But during COVID, what happened? From 10,000, there is a drop suddenly to 5,000. Okay. So 10,000, there is a drop suddenly to 5,000. What is a drop? it is 50%. But then suddenly what happened? Next year, 5,000, it became 10,000. What is the rebound? It is 100%. What was the dip? 10,000, it moved to 5,000, it is 50%. But 5,000, it moved to 10,000. How much is the rebound? It is 100%. That's what I mean by base effect. Because from 10,000, because the base will be 10,000 when you calculate the dip, or when you calculate from 10,000 to 20,000 also, the base will be 10,000. That's when I told you, for have a move of 100%, you need to get a 10,000 point move. But when the economy dipped to 5,000, you just need another double, right? So economy was standing at 10,000. There was a dip of 50%, but then there is a rebound to the original level. Still you are saying what? 100% rebound. So next year, if you see that, you ignore the dip. If you simply look at the next year, what is the growth? It is 100%. But is the economy really moved? It was at 10,000. It is at 10,000 now. Why it happened? Because it went down 50%, rebound 100%, came to the exact level. But if someone look at this, it is 100% growth in that year. Why? It is a base effect. Base is small. Okay, same is applicable in it when it comes to agriculture, commodities, etc. You will see this kind of huge dip in prices, and next year huge move in the price in agricultural commodities. So when you convert into percentage, there can be 100%, 200% difference you will see than normal. Though it is at the same level, it was at 10,000, it is at 10,000, but you are saying 100% growth. Why? Because it suddenly went to 5,000 and then rebound to same level. But when you are calculating next year, what is your base? Your base become 5,000. So 5,000 to 10,000, that is 100%. Okay, that's what I have explained here. And projected growth. US economy expected to grow by 3%. Questions arise about recession fears and all these. 3% is very good for them. Economies like US, UK. Job market cooling, that's a reason for concern. Decreased labor demand. So businesses are reducing hiring, leading to a cooling job market. This trend is a primary driver of recession fears. Now, rising unemployment rate increased from 4.1 in June to 4.3 in July. This uptick is seen as a red flag. So it was 4.1. Unemployment rate is increasing, which is a major concern. Okay. Economic ripple effect. Job market changes impact consumer spending and overall economic health. See how it will be affecting. When you don't have job, will you have the money power to buy things? If you don't have the power capacity to buy things, will that create demand in the economy? No. If there is no demand in the economy, what you will do with the production? Automatically production will also come down. That will affect the GDP. So unemployment means you don't have money power. If you don't have money power, you cannot create demand. See, if you look at the equation or the definition for demand, it is the willingness and ability to buy things at a particular price, particular quantity. It's not willingness. I may be willing to buy an aeroplane, but I don't have the ability to buy an aeroplane. That's the question. Similarly, some person, his basic necessity, that is food. He is willing to have food. He wishes to have food, but he is not able to buy food. His necessity even won't create demand in the market because he don't have money to buy food. Okay, so that is very much required. If you need to create demand, you need to have the buying capacity. Okay, that we discussed. The Sahm Rule predicting recession. So definition: Sahm Rule compares current employment to its 12-month low. A 0.5 increase signals potential recession. So current status, US unemployment have been steadily rising. The economy may be approaching the Sahm Rule threshold. So that's why this. Guys, if you are looking for prelims this year, there can be a potential question. You just look into what is Sahm Rule and the details. Forgot to get, this is the definition which I have given. Just go in depth and see the details also. In case further news is coming related to recession, this can be asked. What is Sahm Rule and how it is calculated and other things can be asked. So implication: if the Sahm Rule threshold is crossed, it would indicate an immediate economic downturn. So what is the threshold? This one. You will compare current employment to its 12-month low. A 0.5 increase. Okay, now inflation and interest rates, a delicate balance. June 22, US inflation hit 40-year high of 9.1. Federal Reserve being, have brought some aggressive interest rate hikes. So why you are increasing the interest rate? To reduce the money supply. Now, why here you need to reduce money supply? Because of inflation. Why inflation? Because of huge demand. When the demand is high, prices will go high. How to reduce the demand? Reduce money supply. How to reduce money supply? Increase the interest rate. See, increase the interest rate, what you're doing is, cost of money is getting higher. Okay? So, automatically money supply will reduce, you won't borrow, and the demand will reduce, ultimately inflation will come down, prices will drop. 21-23, what you have seen is Fed implements 11 interest rate increase. Borrowing, this is the point which I have told you, cost of money will increase, that means borrowing cost will increase, and demand will decrease, that means slowing business investments and hiring. So this is the implication of increasing interest rate. On one side you can control demand and reduce price, and you can tackle inflation, but the offshoot is, when the demand is less, the production will automatically come down. It will affect the growth or GDP. So interest rate hike is not good for the growth. Okay, so if you remember when I discussed about the COVID, at that point of time I have discussed about some stimulus. Stimulus means reducing interest rate to create demand. That will increase the growth. Current situation, interest rate between 5.25 and 5.5, higher rate impact business operations and expansion plans. How it affect the other business? See, firstly, when interest rate is high, people won't borrow, spending will come down, demand will come down, it affect the production anyway. So the profits will be affected. Secondly, the business also want money. How they get it? The entrepreneurs, the companies, they will have to borrow. Now their cost of borrowing is also high to do the business. So they also face the problem. So automatically the growth will come down. Yeah. Bond yield inverting the curve. See, normal yield curve, typically long-term bonds have higher yield than short-term bonds. This indicate economic optimism. This is a normal situation. See, I hope these basics you know about long terms, 5-year, 10-year bonds, and short-term 1-year, 3-year bonds, like that. Now, inverted yield curve, short-term yield exceed long-term yields. So typically long-term bonds have higher yields. But if there is a situation like this unusual situation often precedes economic downturns. When the short-term yield is higher than the long-term yield, that indicate a downturn. Now, current status, if you look at US bond yield have inverted, so this situation has come. So that is also a reason for this discussion. This signals potential lack of confidence in future economic growth. Okay, now US economy beyond employment. GDP growth remains 3%. This indicate overall economic strength despite job market concern. I told you, if GDP growth is going up and unemployment is also going up, not a big concern. Unemployment going up, GDP is coming down, that's a big concern. So here, though unemployment is there, but the GDP is strong as of now. 3% is very good for their economy. It's a big economy, so 3% is huge. Corporate margins. Many US companies maintain healthy profit margin. This again suggests resilience in the business sector. Consumer spending, credit card usage remains robust. See, spending is there, that means demand is there. So I told you two things. GDP should be steady, not much concern. Demand should be steady, that means consumer spending should be steady, not much concern. Even if on one side unemployment or less job opportunity is there. That could be the advancement of technology and other things indication. Now, US India trade relation, if you look at, these are the export category mainly, and IT service, almost 8% growth, pharmaceuticals, 6% growth, textile, 4%, machinery, 5%. Potential impact on Indian markets. See, short-term effects, if you look at the recession could reduce demand for Indian exports. IT services and pharmaceutical may see decreased orders. This is a normal case only. If there is a recession, demand will come down. So that will affect India. Short term, long term, India's diverse export portfolio may help mitigate impacts. New opportunities could arise in certain sectors at that point of time. Now you're focusing more on pharmaceuticals and IT, so you need to focus more on other areas so that if you have a diverse portfolio, if you look at ones which I have explained, we are more focused on certain aspects. So if you have a diverse portfolio, or when you struggle here, you may try to find another opportunities, and a diverse portfolio will match it long time. So you will go for adaptive strategies depending on the situation. So Indian business may need to diversify markets, not only US, other markets also, not only certain areas, all other areas also. Focus on domestic consumption could offset export declines. Okay. India's economic resilience, strong GDP growth. So India's GDP is again very strong. It's around 7%. World Bank revises India's GDP growth forecast 7%. This indicate overall economic strength. And if you look at stock market, Indian stock market shows stability with all these global uncertainty. This suggests investor confidence in India's economy. Increasing foreign investment, investors continue to show interest in Indian markets. This could help buffer against any global economic shocks. FDIs, foreign direct investment, FIIs, foreign institutional investments, both are increasing. Though if there is any shocking news or anything, FIIs may create some problem, but FDI, huge FDI is there when it comes to India. Okay, so global economic interconnectedness, trade networks, complex web of global trade relationship, economic events in one country can quickly impact. See, it's a world of globalization. So, of course, everything is interconnected. If one country is affected, especially countries like, if you take few countries like US, UK, Russia, when it comes to crude oil, the entire UAE region, if it affected, right? So, it will affect the entire world. So, that's the kind of connectedness world have now. Everything is interconnected. Financial market, again, interconnected financial system allow rapid transfer of capital. This can amplify both positive and negative economic trends. So capital, see, I told you just before FIIs, if there is any sudden shock, FIIs can take out money from all of a sudden. FDI, that can't happen, right? If you are investing directly in infrastructure. FIIs, you are investing in the stocks and other things. So this is more liquid. FDI investments is not that liquid. So flight of capital is possible when it comes to FII. They can take it away and they can take it to any other location and can invest over there. So here we are going to face a disadvantage if that happens, flight of capital, but they'll be investing some other country, they'll get the Forex. What's the most important point that you're looking at is whether it is FDI or FII, are you getting the Forex? Forex is the power, okay? Dollar. Digital economy, technology enables global business operation. This increases economic independence across borders. So conclusion, how we are going to deal this is what we have discussed so far. So cautious optimism, we have that optimism, but still we need to be cautious. While recession fears persist, many economic indicators remain positive. A balanced perspective is crucial. What are that economic indicator which remains positive? GDP is strong. Demand is there. Consumer spending is there. Production is also there. What's the issue? Issues with the unemployment mainly. Okay, guys, please look into the Sahm Rule. That is important. Global preparedness. Countries must prepare for a potential economic shift. Diversification and resilience are key strategies. India's position, India's strong economic fundamentals may help weather global turbulence. Continued focus on growth and stability is essential. So that's it, guys. Thank you so much. I hope this topic is clear. See you guys in the next session.